together physically once again today for this event. It is truly a European event because we have panelists from the UK, from France, from the Netherlands, from Belgium. So this is very much all parts of Europe coming together virtually for the conversation this afternoon, which is looking at the contribution of capital markets and asset managers to good DC outcomes. And I think given the market turbulence that we have seen through this year, and indeed probably are likely to see in the coming year, it's a particularly good time to take stock and look at some of the issues with a longer lens than simply the short-term volatility that often characterizes the DC experience. And with that in mind, I'm particularly delighted to welcome from the OECD this afternoon, Stephanie Payet, who is a private pensions analyst at the OECD, and Pablo Antolin, principal economist and head of the private pensions unit at the OECD. And Stephanie is going to take us through a presentation of preliminary results from a new piece of work that the OECD has been conducting, looking at the historic experience of investment markets, which I hope will then frame a debate between the panelists that will form the second part of this afternoon's event. Stephanie and Pablo will join us on the panel, and let me just very briefly introduce the panelists before we hand over to Stephanie for the presentation. I'm just going to go around in order of the screen. So James Beaumont, head of multi-asset investment and advisory and fund research at Natixis Investment Management. Welcome, James. Justin Ray, who joins us from EIOPA, where he's head of policy department. Great to see you again, Justin. Philip May, who is group director of retirement income at Capital. Great to have you on the call, Philip. And last and definitely not least, Onno Steenbeck, managing director of strategic portfolio advice at APG Asset Management. So we couldn't wish for a more experienced and better qualified panel for the discussion this afternoon. So I'm looking forward to that. But in the meantime, I'm going to hand over to Stephanie to take us through her presentation. And as I say, just to stress that these are preliminary results from the study, but I think we are going to find them all extremely interesting. And we will see you, the audience, as a group in about 20 minutes for the discussion. So Stephanie, over to you.
Thank you very much, Jonathan. So this is, thank you, first of all, for the opportunity to present this ongoing study, as you were saying. We are very grateful for this opportunity. And so this is a study about the assessing the contribution of capital market to DC retirement outcomes. So basically the objective of this study is to assess how different investment strategies would have performed historically for different of plan members contributing to defined contribution pension plans. And for that, we use historical data for investment returns, inflation, and interest rates between 1900 and 2021. And we have those data for 19 OECD countries plus EU as a whole. And we managed to therefore follow 83 cohorts that would have retired between 1939 and 2021 and look at their replacement rates given different investment strategies. And this project is actually part of a broader project aiming at developing implementing guidelines for the OECD's recommendation for the good design of defined contribution pension plans. So just going quickly through the methodology to explain later on the results. So we follow those 83 cohorts and we calculate for each of them hypothetical replacement rates that they would have had if they had saved with different investment strategies in a defined contribution pension plan. And we basically follow for each cohort a representative or an average individual. And that individual joins the labor market at the age of 25, as earnings growing in line with inflation, but historical inflation in each of the country analyzed, and a constant productivity growth of 1.5%. That individual saves 5% of earnings over 40 years, but we also relaxed that assumption later on. As I said, we are comparing different investment strategies, and we use the historical returns for each country for 4 different investment classes or asset classes: domestic and international government bonds, as well as domestic and international equities. Then we assume that the individual representative for each cohort retires at the age of 65, and at that time buys a 20-year fixed-term annuity based on the interest rates that are prevalent at that time. So it's not a lifelong annuity, it's an annuity that pays benefits for a fixed term of 20 years. And as I said, we are relaxing some of the assumptions later on. And we are comparing 4 different investment strategies: a fixed portfolio of only domestic government bonds, a fixed portfolio of only equities, a portfolio with a mix of equities and government bonds, and a life cycle investment. And for the last 3, we use a mix of domestic and foreign securities. So basically what this study is confirming is the benefits of diversification. If we look at the different cohorts, we see that investing part of the contributions in equities for 40 years would have paid off for most cohorts. So if you look at the graph on the left, so these are results for Europe as a whole. So on the left, you have the evolution of replacement rates for the different cohorts over time, based on their year of retirement, and for the different investment strategies. So the black line is the domestic government bonds portfolio, and then the blue at the top is the full equity portfolio, and in the middle you have the mixed portfolios. And what you can see is that for most of the cohorts, they would have received a higher replacement rate with one of the 3 portfolios with some equity exposure compared to the government bond only portfolio. And on the right, it's actually making an average of all those cohorts to have a more compact figure and illustration. So the blue bars, are the lump sum that people would have received at retirement, but expressed as a multiple of final salary, while the dots are the replacement rates that they would have received. And just to give you an example, for the domestic government bonds, on average, so across those 83 cohorts, people would have received a lump sum equivalent to 275 times their final annual salary. And this would have been equivalent to a replacement rate of 18%. And if we go to the other extreme with the diversified equity portfolio, the lump sum they would have received on average would be equivalent to 4.77 times their final annual salary and a replacement rate of about 34%. So definitely a big improvement with equity portfolios. And this result is not only valid for Europe as a whole, it's actually valid for all the countries we analyzed. Across all the countries, at least 75% of the cohorts would have been better off with the 3 portfolios with equity exposure compared to the domestic government bonds portfolio. So here the graph, the minimum is actually 70%. So everything is actually above 75% of cohorts better off with some equity exposure compared to only government bonds. And then we looked at the situation when cohorts are better off with equities and when cohorts are better off with bonds. So if you look at the graph, there are 2 bars. So the blue bars represent the cohorts that would have received a higher replacement rate with equities, while the black bars represent the cohorts that would have received a higher replacement rate with the bond-only portfolio. And the bars represent the difference in the replacement rates between the 2 strategies for each of those groups of cohorts. And what you can see is that the blue bars are much higher than the black bars, which means that the upside potential of saving and investing in equities is than the upside potential with a government bond. So if I take the example of Europe again, and the blue bar means that the cohorts that would have received a higher replacement rate with equities, which are actually 75 cohorts out of 83, would have received an average and a replacement rate on average higher, 17 percentage points higher compared to the domestic government bond portfolio. While if I look at the black bar, which are the cohorts that would have been better off with the domestic government bonds, there are 8 of those cohorts out of 83, they would have received a replacement rate higher, just 2 percentage points higher than with the diversified equity portfolio on average. So that means that the investing in equities provides a large upside potential and actually minor potential downside. But obviously, there are always trade-offs. And with equity portfolios, we see that the outcomes are much more volatile. This graph is showing the standard deviation of replacement rates for each country across the different cohorts. And you can see that the volatility, the standard deviation, is nearly always much higher with equity portfolios compared to the domestic government bond portfolio, which means that with portfolios with equity exposure, a cohort is more likely to obtain a replacement rate that will be different from the preceding and the following cohorts than if they had invested in government bonds. And this disparity between the cohorts and the replacement rates that different cohorts would receive is higher when you have the full equity portfolio. So this is also showing that there is a need to diversify portfolios, that there is a downside to have only equities, and this downside is the volatility. Another interesting result referred to what life cycle investment strategies can bring. If we compare the life cycle investment strategy to the portfolio that remained invested in equities all the time, on average, those life cycle investment strategies will produce lower replacement rates because they reduce the allocation to risky assets during the last 10 years before retirement. But because they do that, they also mitigate the risk of large losses just before retirement. So here we see for Belgium a comparison of the replacement rates that the different cohorts retiring in different years would have received with the diversified equity portfolio, which is 100% in equities all the time, and the life cycle portfolio, which is in equities for 30 years and during the last 10 years reduces the equity allocation to 20%. And we can see that most of the time the life cycle provides a lower replacement rate than the full equity one. But if we focus on the year, for example, right after 2000, we see that the effect of the life cycle is to actually protect from the fall. So, for example, with the full equity portfolio, the replacement rate for the cohort retiring in 2000 would have been around 59%, and it would have dropped to 46% for the cohort retiring in 2001 and to 34% for the cohort retiring in 2002. While if we look at the replacement rates produced by the life cycle investment strategy, actually those 3 cohorts retiring in 2000, 2001, and 2002 would have received a comparable replacement rate of around 50%. So the life cycle investment strategy can really mitigate the risk of large losses. Another interesting result is that actually the differences between the different strategies tend to be lower for cohorts who would have retired in the early 40s or after 2000. And this is quite consistent across the different countries we analyzed. And one reason is because there have been several equity market crises between the 2 world wars and also since 2000. And those equity market crises have lowered the average return that the cohorts invested fully in equities would have received, and therefore lowering the comparative advantage compared to the government bond only strategy. But obviously, assuming contribution period of 40 years is quite optimistic, especially if we are in a country with a voluntary participation in asset-backed pension or in DC pension plans. So we also look at the effect of the contribution periods, the length of the contribution periods, and we look at 20 years, 30 years, in addition to 40 years of contributions. Obviously, the longer people contribute, the higher will be the replacement rates, independently of the investment strategy being analyzed. But you can see that the differences are much higher for the portfolios with some equity exposure. So it shows that saving early is very important to benefit from compound interest, especially when this compound interest is combined with high returns that the equity portfolios can provide. And also we look at, okay, well, if people cannot contribute for 40 years, but they contribute a higher percentage of their income, maybe they will end up in the same place. And actually the contribution rate that is needed to offset the negative impact of shorter contribution periods can be quite high. Here in this graph, we show the average replacement rate across cohorts in the United States. The blue bars are assuming 40 years of contributions with a 5% contribution rate, while the orange bars look at a contribution period of 20 years, but with a 10%, so double contribution rate. And for the domestic government bond portfolios, actually, the results is quite similar between the two scenarios, but you can see that it's not the case when you have equity exposure. And this is because contributions do not benefit from the compound interest effect for as long when the contribution period is only 20 years. And even doubling the contribution rates will not substitute the interest income that would have been earned in the first part of the career. Now moving to the payout phase, we first look at what was the impact of the interest rates on the replacement rate that we calculate, because in the initial part of the analysis, we assume that people buy a fixed term annuity, given the interest rate at that time. And what we can see is that the low interest rate environment that was prevalent during 2009 and 2021 would have reduced the replacement rates for the cohorts retiring during those years with a fixed term annuity. Here, I'm showing an example for France. So the black line is the replacement rates that the different cohorts retiring in different years would have obtained with at the time, while the orange line is representing the same thing, the replacement rate, but assuming the same interest rate for all the cohorts of 4%. So no variability across cohorts on that parameter. And the gray line is actually the interest rate in France during those years. And as you can see, during the period between 1970 and 1990, interest rates were quite high. So the replacement rate that you would have received when using the market interest rate is higher than when using a fixed interest rate of 4%. But if you look at the end of the chart to the right, you see that with the low interest rate that was prevailing between 2009 and 2021, people have lost quite a lot of replacement rate because of the low interest rate. So, for example, in France, the replacement rates were below 1% during that period. And an example for the cohort retiring in 2021, using the market interest rate of minus 0.6%, they would have received a replacement rate of 30%, while if it was an interest rate of 4%, they would have received a replacement rate of 45%. So that's quite a sizable difference. So showing the impact of the interest rate when you buy an annuity at retirement. So the next step was to actually look at what happens if instead of buying an annuity, people stay invested in retirement and take a drawdown product. And what we clearly see is that investing in equity markets during the buyout phase or through a drawdown would have benefited most cohorts again. In this graph, I'm showing the average replacement rates across cohorts for the UK if people would have gotten a fixed term annuity versus a drawdown. And being invested in a domestic government bonds during retirement doesn't really change much compared to buying a fixed term annuity. The difference is quite sizable again when you have some equity exposure during retirement. And the same way, as I showed you before, I'm comparing the upside potential of saving during retirement and having a drawdown, as opposed to buying an annuity a fixed term annuity at retirement. So the blue bars are for the cohorts who would have been better off with a drawdown, and the orange bars are for the cohorts who would have been better off with an annuity. And again, you see that the blue bars are much larger than the orange bars in most of the countries that we analyze. And for Europe, for example, among the cohorts better off with a drawdown, they would have received a replacement rate 31 percentage points higher than with a fixed term annuity on average. And by contrast, they would have only lost 7 percentage points of replacement rates by being in a drawdown instead of buying a fixed term annuity. But again, well, like always, there is a trade-off. Obviously, the potential is that you will get higher benefits with a drawdown instead of a fixed term annuity, but benefits will be more volatile during retirement with a drawdown because the benefits will be constant in nominal terms with a fixed term annuity, while they will fluctuate with investment returns with a drawdown. Here we showed the example for one cohort in Portugal retiring in 2002. And you see that basically due to the 2008 crisis, the benefits will drop with the drawdown, while with the fixed term annuity, all the benefits will stay the same in nominal terms during the 20 years that we assume that the payout phase will last. So just to conclude, this study illustrates the benefits of investment diversification. Retrospectively, we see that most cohorts would have been better off having some equity exposure in their DC plan rather than being only in a domestic government bonds portfolio. However, we see that starting to save early is quite critical when you invest in equity markets so that you can really benefit fully from the compound interest. When looking at the payout phase, we see that most cohorts, again, would have been better off actually staying invested during the payouts, so taking a drawdown instead of a fixed term annuity. And it's important also to keep some equity exposure during that retirement period, because taking a drawdown fully in domestic government bonds doesn't really bring much compared to a fixed term annuity. However, equity exposure increases volatility. So that's why it's important to have diversified portfolios with equities and with domestic government bonds. So it shows also that investing in domestic government bonds only or buying a guaranteed income at retirement may forgo significant retirement income benefits comparing to investing at least part of the contributions in equity markets. And people always talk about the protection provided by conservative investment strategies and guarantees, but this protection, at least when looking historically at the cohorts who would have retired between 1939 and 2001 and 2021, in different countries, this protection may have been only moderate, because we have seen that the portfolios with equity exposure may only produce slightly lower replacement rates than government bonds only portfolios in case of negative events. So I'll stop here. Thank you for your attention, and looking forward to hear the reaction of the panel. Thank you.
Great, Stephanie, thank you so much for taking us through a incredibly diverse and interesting set of findings so fluently. There's a lot of very, very interesting points that you've raised that I'm sure we'll want to pick up with the panel. I'd like also just to mention to those of you watching the webinar, please feel free to post questions or comments as we go through both the immediate discussion on the OECD findings and also our broader panel discussion that's going to be looking ahead a little bit more. And we'll try and pick them up as appropriate as we move through. You can use the chat function in the WebEx. But just to get us started, what I'd like to do is an initial round of key takeaways from our panel to what we've just heard, and maybe I could start with you, James, just to give us your top line perspectives on these findings.
Sure. Hi everybody. I think it kind of fits in with our view of the world in terms of the need for diversification, which is something I'll be speaking more on in a moment. I think one of the questions I have for Stephanie, a bit unfair for me to put her back on the spot, was whether or not she ran some analysis showing a kind of 50-50 portfolio, because I think perhaps one of the key stories here is that it's not necessarily fair, particularly going into post-retirement, to make individuals make such a momentous call as to what they should be doing, 100% annuity, 100% kind of drawdown. Would it be better from both diversification and controlling volatility to have 50-50, to split their options more? So I don't know if Stephanie ran that analysis, but that was the thing that really kind of sung out to me.
Super, thanks, James. Perhaps we'll go through the panel and then come back, Stephanie and Pablo, just to give you a chance to respond to the various points raised and your own reflections. But let's move straight on to Onno and get your reflections.
Oh, similar to the previous speaker, thank you very much for your insights and your research that you did. It fits very well with the intuition, right? That you should start early and take risk. And you can do that in many different forms. But taking the risk in the long run is, and diversify is another thing that fits very well with what we think is a free lunch in finance. So in that sense, it confirms how we already work.
Oh, I think we've momentarily lost Onno on the concept of the free lunch, which I was about to query him on, because I don't know about you. I believe there's probably never such thing as a free lunch, but clearly diversification very important.
I think and diversification probably are free lunches over the very long.
Well, let me bring Philip in on that point.
Well, thanks very much indeed, Chairman. Yeah, I thought it was a great study and really long-term, fantastic to get such a wonderful length of data, and completely resonate with this. I think, the very long-term equities are where you should be funding savings for retirement, and indeed, as you'll hear later on from me, in retirement as well. I just had a short observation. We all know that tax and regulation, we talked about the free lunch, what's it, death and taxes are the only certainties in life, and tax is an issue, and particularly thinking about taxes and pension funds. So, for example, we know that in Australia, there is a huge benefit in taxation terms from holding domestic Australian equities. We know that there's sometimes been restrictions on investing overseas. So when I started my career in 1979, it was really hard for UK pension funds to invest in overseas equities because of exchange controls. I wonder, Stephanie, to what degree were you able to appreciate, you may not have been able to do this, to consider those in your study, and to what extent you think going forward those will become less important in the future, as I'm sure we hope they all will?
Terrific, thanks, Philip. So yeah, some really interesting points there, and let me come to Justin now before coming back to Stephanie and Pablo to just reflect on some of these issues. Justin, the regulator's perspective.
Well, thank you, Jonathan, and thanks to you and to EFAMA for the opportunity to speak at the event. I'm afraid I don't quite buy it, if I may say so. And I mean, I don't mean that in terms of the technical work, which is as others have said, is excellent. But I mean, I got the impression from the slides that this was essentially advising to invest in equities, or at best in some sort of diversified portfolio with lots of equities. I mean, for me, I buy that it makes sense at the cohort level, but I'm not sure it will always make sense at the individual level. And I mean, it will depend on circumstances. I mean, 75% of cohorts are better off, as Stephanie's charts showed. But I mean, that means 1 in 4 are going to be worse off. Now, if you are an individual and this pension is your only income, actually, if you're offered a 1 in 4 chance of making a loss, you may say, thank you, I'd rather have something that that reduces my chance of loss. So it will depend on, is this a top up to your other pension income, property income, state pension or whatever, or is this all you're relying on? Likewise, I mean, it also shows to me how expensive DC pensions are. I mean, even if you invest for 40 years, which as Stephanie acknowledged is quite unusual, and you put it all in equities, you're prepared to take the risk. I mean, the best you'll get is a replacement rate of 35%. Again, you might say, well, look, if I'm only going to get 35%, I'll take 25% with more certainty. Related to that, from what I could tell on I think it was slide 5, I mean, there was, over the last 10 years or so, has been kind of significant convergence in outcomes. Whereas for previous cohorts, the equity solution was definitely superior. Actually, the replacement rates, equities compared with the other alternatives, much more convergent in the last 10 years. So this may have been generally true, but I'm not sure it is necessarily true sort of in the last period. Thank you.
Great, thanks, Justin. And I'm going to actually, I've got some questions for you that I'm going to just hold fire on for a moment and hand over to Stephanie and Pablo just to reflect on the comments from all of the panelists, which I think sort of raised some quite significant issues, particularly I think from Justin's comments, both about sort of long run capital market returns, but also the relationship between private pension and state pension as we think about different configurations in particularly in European countries, of course, for this call, but more broadly. But maybe just to give you an opportunity to respond to the points that you've heard so far.
Thanks. So maybe I can start, and Pablo can can complement if there is anything that I missed. So thank you very much, first of all, for all the good comments. Obviously, this is a 20-minute presentation, so I couldn't present everything. So to the point of James, we actually looked at the 60-40%, 60% bond, 40% equity portfolio for the payout phase as well. We didn't only look at the 2 extremes, but yes, I only show the extreme situation or comparison in the chart. On Philip's point about the tax incentives for investing in domestic rather than overseas investments, well, the OECD is doing a lot of work on tax cooperation. So with that in mind, I would tend to think that indeed this issue of different incentives to save or to invest domestically versus overseas will maybe not disappear, but will get reduced. And several good points from Justin. So yes, this analysis is really at the cohort level. And we definitely want to complement this analysis with historical data on cohorts, with another analysis with stochastic analysis at the individual level. Because as you say, even if a cohort is better off with equities, let's say, as compared to government bonds, but retired in 2008, we actually see that they are still above the government bonds, but each individual has suffered a loss. So even though the cohort overall was still better off than with just government bonds, the individual has suffered a loss, and that loss can be bearable for some individuals and not at all for others, because as you were saying, it depends on the role that the DC pension is playing in overall retirement income, and how it complements public pensions. So definitely we want to complement this analysis that is at the cohort level by an analysis at the individual level. Then yes, we only assume a 5% contribution rate. So with 5% contribution rate, it shows that you cannot do miracles even in DC pensions and even with a full equity portfolio. And on average, you would get a replacement rate of 35%. It shows the importance of contributing for long periods and contributing enough, because there are some countries that made some assumptions in the past that they will get wonderful returns and that people, if they don't contribute more than 10%, they will be fine and they will get 70% replacement rate. Well, this analysis is showing that this is not the case. You need also to combine a long contribution period with sufficient contribution rates, given the objective, again, of the DC pension arrangement, whether it's mandatory and the main source of retirement income, or whether it's complementary and just supplementing the main public pension scheme. And yes, I think the convergence of the results across the different investment strategies is interesting to witness. However, like everything else, we don't know whether the past will repeat itself in the future or not. So we don't know whether the future will look like the years during the 80s and 90s, or will continue to be like it was in the 2000s. So that's why it's important, again, to complement this historical cohort analysis with more stochastic analysis, and this is what we are planning to do.
Thanks, Stephanie. I mean, I must say I was particularly struck with this point about the relationship between contribution level and replacement rate, and what would happen if we actually inputted the typical DB pension contribution levels, which are now running, certainly in the UK, often in excess of 30% of salary, to look at outcome. And sometimes I think we assume that outcomes are poor in individual investment plans, effectively the money purchase of the DC universe, without perhaps taking enough account of the fact that contribution levels tend to be typically so much lower than those that we've seen in their sort of defined benefit funded counterparts. Shall we just come to Pablo as well, because obviously, Pablo, you've had a great involvement in this project as well, and I very keen to just get any reflections from you on the conversation so far, and indeed anything in the results that may have surprised you in the context of the extensive work that you've done over many years in this area. Oh, you're muted.
Thank you, Jonathan. I would like to start with your last point that links to what Justin said. You can always look at the issue of the cost of defined contribution systems or the benefits of defined contribution system. It's true that the report suggests that the maximum replacement rate you can achieve is 35%. But as you were saying, Jonathan, we are only assuming a 5% contribution. So if with a 5% contribution, you can get a replacement rate of 35%, that seems to me quite good as you compare with contribution rates in other systems, whether funded or public, of 20%, like is the normal thing. For me, I would like to highlight what Stephanie said, that what the study shows, and this is just historical, we will be doing stochastic, is that diversification is good. The upward potential is quite impressive, but obviously we have the problem of volatility. And this is something that we always have to take into account, because as Justin said, when you think in terms of individuals and the other components of the pension system, having a lot of volatility can be really a problem. And there are people who actually don't like volatility. So, and people compare with their peers just 1 year before, things like that. And when you have a shock, that becomes a serious problem. And in terms of a shock, the other big thing that we always highlight, and it is in the OECD recommendation for the good design of the C pension plan, if you as a regulator want to protect people for big losses just before retirement, if there is a big negative shock just before retirement, life cycles seem to work. Obviously, in general, as the study shows, you are always better off with high exposure to equity, but the shocks are quite substantial. Some people, I might say, is writing in the thing, what will be the case if we are in a wall of higher interest rates? And because in the last 10 years, we have low interest rates. In my opinion, it will be similarly. What is important is not whether we are in a wall of high interest rates or low interest rates, because returns will adjust to that as well. If you look at the analysis that Stephanie say in the 70s and 80s with high interest rates, return seems to be quite much higher. The problem is the shocks. And what I think we have had in the last 10 years, and why it looks this convergent in the last 10 years, is because we have had a lot of negative shocks, and we are still living through a lot of negative shocks. So in some sense, in a wall of shocks, any investment strategy that you use that is not extremely risky, they're going to converge in some sense. I'm not an investment expert, but I believe that when there is a lot of uncertainty and a lot of shocks, one after the other, convergence is where things are going to happen, and it's going to converge downward, not upward. And that's what I believe. And finally, taxation is important and will always be important. And how taxation is established in terms of benefiting certain type of investment is going to bear very heavily in the decision making of investors and people. It's always the case. Thank you.
Super, Pablo, Stephanie, thank you very much. I know you're staying with us for the panel discussion, and I hope you'll take part in that. And we're going to shift focus a little bit now to the current environment. And Pablo has sort of set the scene quite well there in terms of his description of the volatility and shocks, which seem to have come along over the last decade, perhaps a lot more frequently than the statistical models would suggest that they should. And on that sort of subject, I'd like to maybe just come straight back to Justin with an initial question about the challenges facing pension savers in the current macroeconomic environment, and sort of looking ahead over perhaps the next few years. Perhaps extending some of your observations earlier about sort of the tension between cohort and individual effects as well.
Sure, thanks, Jonathan. I mean, challenges facing pension savers. I mean, there's a lot on there. I mean, there is the economic situation, inflation, energy prices. There is low growth and therefore concern perhaps about future unemployment. There's issues of affordability if the cost of debt is rising, your mortgage payments and so on. I mean, in those circumstances, I think you're going to want to trust your pension. There is clearly going to be pressure on what you're setting aside for pension compared with all the other calls on your finances, and you will want to trust that your pension is well run, well governed, investing wisely, in order to keep the contributions up. Otherwise, of course, you face the risk either of reduced contributions, and I mean what Stephanie's analysis showed was that reducing during the accumulation phase has sort of significant adverse consequences, or indeed, as we've seen in some countries, people just drop out of the pension system altogether, or at least drop out of the private pension system. So there are a lot of challenges, and in such a difficult environment, having good trust in the pension system is even more important. Thank you.
Thanks, Justin. And yeah, I absolutely agree. And I wonder, Onno, I know you're having a few connection difficulties, but if you're able to come in just to sort of think about this question of trust and some of the challenges facing pension savers presently.
Yeah, trust is the key word for pensions in general, and I think that's the most important issue currently also in the Netherlands that we are struggling with. So can we keep up our promises, and do we do what we tell people to do, and can we devise a system that fits well with what people actually need when they retire? This is the key metric. I agree with Justin what he just said. The challenges are manifold. And in that sense, we look at points that Justin made, the aging trend that is continuing, and the pension, the baby boomers that are currently retiring. And that's, I mean, in general, let's leave it at that and see whether we can keep up the trust. What Justin earlier already is something that resonated with me. Let's say, how if you do it well for the majority, what do you do for the outliers, right? So, to what extent should you protect the outliers to the downside, and to what extent can you use some of the upside that is very generous for certain cohorts in order to let's say smooth results? As I tried to say in my earlier intervention, we have seen one history only, and as Stephanie already indicated, we need to do this stochastically to see where the outliers lie, what we can do about them.
No, really interesting point, Onno, and I can see Philip would like to come in on that specifically.
Yeah, well, it's a very good point, and actually both Justin and Onno have raised really good points. I mean, I feel guilty as a member of the boomer generation because I think in a sense, you know, we've had a lot of the upsides, and Stephanie showed all those returns which had accrued in the 80s and 90s. And that's obviously to a large extent baked in, and then you get the benefit of the de-risking and the glide paths I'll talk about later on. I think all is not lost, I think, for younger generations. So I would point, you know, Justin talked about dropouts. I think auto-enrollment, which has been a feature, and I don't know how far that's the case in other countries, but in the UK, that is a feature, and it's quite strong. You know, the vast majority of people do not drop out because of auto-enrollment. It takes a big step to drop yourself out. So I think auto-enrollment will help enormously and keep people saving. And as Stephanie showed, it's that consistency over 40 years, which is more important than anything else. And I think on the point that Onno raised, I think you can use Pillar Zero of the World Bank 5-pillar system, which is state support for those people who have lowest incomes and lowest propensity to save. You, in addition to the classic Pillar 1, which obviously we have in the UK as a state pension, you can use more Pillar Zero support in the form of state subventions. And I think we'll have to do that. And of course, you know, the reality is that aging populations do mean that that inevitably will come through in taxation. We have to try to manage that, but it's a reality.
Yeah. Yeah, very much so. And I was sort of reflecting as well while everyone was speaking about a sort of another discussion that we could have, although we may not have time to have, which is really, I think Justin was sort of hinting at it, Onno's comments were hinting at it, and Philip, I think we were starting to get into that, which is whether we have the right system in terms of individual DC and whether collective DC can deliver something. But that actually is it's a whole other topic. And what I'd like to try to do, I think, sort of bank those really interesting initial observations and come to James actually to talk about investing in DC in the current environment, where some of these aspects of trust link directly to how we can provide the right balance of growth and protection in our asset allocation. And particularly in an environment over the last few decades where we've become used to a certain pattern of behavior between equities and bonds in particular that appears to have broken down. And therefore, how can we construct an investment strategy that offers protection in an environment where it seems that some of those traditional relationships are just not functioning?
Yeah, I'm going to be a little bit boring here, I'm afraid, because the answer to our mind is still about diversification. The question's an interesting one because you talk about protection for pension savers, but the first question is protection from what? Because is it protection from inflation, in which case you can't de-risk completely. You've got to take some risk. So then it's the protection from taking risk to generate the return that you need, at least for some part of your portfolio. But to do that, there's definitely a case, as we've just seen, for taking some equity risk. But you need, in our view, to diversify, to build, what we term as durable portfolios that can withstand the volatility. Because to the earlier comments, volatility has been around. It is not going away. If anything, it's only going to be more enhanced in the coming decades. So, in terms of a strategy for this, I think it's important that the starting point is around the strategic asset allocation. And I think what we find in conversations with our clients is it's important to give your asset manager a degree of flexibility. I think people who've been very tied to a benchmark with limited amounts of tracking error have found the last year in particular very difficult. So giving a degree of flexibility when you set your strategic asset allocation. Then at that starting point, it's viewing risk as a starting point, not something that happens to you. So control your risk. To Justin's point, different people have different levels of risk, and they have different levels of risk within different buckets of their investment. If they've got a pension pot here that's got an annuity, then maybe they can afford to take more risk elsewhere, and vice versa. So I think the breakdown in correlation, the traditional negative correlation between equities and bonds, was coming. It's not a huge surprise. It will come and go through the ages. We think it will probably return. We think that fixed income still is a crucial part to play, but diversification, where you can consider liquid alternatives, where it's appropriate, consider private assets, using equities. There's a lot of tools, and we would encourage people to use them all.
Thanks, James. Philip, can I bring you in on that point as well to see whether you agree with James and to take us into a sort of broader discussion also about that life cycling point?
Yeah, sure. So just, I completely agree with James. Flexibility and diversification is really important. Those are the two key things which will as much keep you out of trouble as it is possible to do. The immediate capital protection lies in the form of cash. And of course, in the UK, we have this, most people who go into retirement from DC schemes take the 25% tax-free cash because they're worried if they don't take it now, it will disappear. So there's a kind of tax driver for this. But of course, as James mentioned right at the start, if you use that tax-free cash too much to draw down from, then you have a significant pot of your money which has any protection against inflation. And so you absolutely, I go back to equities and bonds typically, and Stephanie's work has already shown the benefits of investing in equities. higher returns to be earned over time on any reasonable assumptions. And we have always been advocates of equity investing for retirement. And one of the points I'm making in the life cycling section, we go on to the next question, is that actually probably in retirement you also need significant equity as well. But if I may, I'll just add a couple of points. I think, and Pablo I think touched on this. Many, and Justin to a certain extent, many people are quite uncomfortable with equity investment. I saw some, I think it was polling data about in Australia, which showed that people in Australia were really, really worried about like a 5 to 10% fall in the value of their assets. And I think getting people more comfortable with a degree of volatility and demonstrating how over time that volatility works through, I think is quite important. So investor education, I would say, is something that we need to spend more time and effort on, particularly with people in DC schemes. And just going back to bonds, I wouldn't want to close off this question by agreeing with the proposition that bonds cannot fulfill their role as an effective buffer. They haven't done so in 2002. But they ought to be able to do so over time. And you've got the 4 key roles of bonds: diversification from equities. That's been tough this year, but over the long term, it's true. Capital preservation. Actually, that's more important in the latter stages of retirement, probably shorter dated bonds, and I think that's still very valid. Obviously, for non-domestic bonds, you probably want to hedge investment grade bonds too, otherwise the FX volatility can just overwhelm everything. And then income, and of course the good news, this insofar as any good news this year, the good news has been that you've got income has returned to fixed income, if I can put it like that, with US Treasuries now yielding about 3.5%. You're in a much better situation. I think from a UK perspective, the one thing I've really noticed, which was a huge shock, was that the inflation-linked gilts have performed so poorly. You expect inflation-linked gilts to offer you some protection against inflation, but you've seen falls in ILGs about 33% in some cases more in longer-dated inflation-linked gilts, and as a result of blowout in real yields. So you have to do the homework on all of this, really. But my key points on this question would be the diversification point, which James mentioned right at the start, being able to manage portfolios actively to protect against changing market conditions, and do your research, do that intensive bottom-up research, which I think the vast majority of investment managers really focus on. It's a bit of a long answer, but that's my thoughts about that.
Terrific, Philip. Just before we get into life cycling, I noticed, Pablo, did you want to come in on a couple of these points?
If I may, yeah, it will cover other points, but if I understand, we are discussing about how capital markets can help in this macroeconomic situation of uncertainty, inflation, and things like that. When we talk about that, we have to, at least in my opinion, from a macroeconomic point of view, not from a financial point of view, what is the purpose of a defined contribution pension arrangement? And the purpose is just that it's for saving for retirement. It's an instrument to save for retirement, like public pensions or DB funded pensions. It's instruments to save for retirement. And the idea is always to contribute certain amount of money to get the maximum retirement income possible. So we have to be clear that in this macroeconomic situation, investing in capital market is not going to give us wonderful retirement income as in the past in better economic situation. Why? Because growth is low, productivity is low, inflation is high. But when we talk about this kind of arrangements to save for retirement, the DC, we have to compare them with something else. And the something else are the other retirement saving arrangements. Public pensions are not going to give much either. Why? Because growth is low, productivity is low, inflation is high. And DB are not going to produce much because exactly the same reasons. We are in a situation of low growth, low productivity. Low productivity has been with us for a long time, and probably, and this will be a very interesting study. We were talking before about what happened in the last 10 years that nothing produced much. Well, we have low productivity in most economies. Since the 1990s, productivity has been extremely low. And this is one of the key issues in the UK as well. So, yes, VC as an instrument to save for retirement is not going to be that good compared with itself in the past. But we should not be comparing with itself in the past. We should be comparing with other instruments, because we are in a macroeconomic situation of low growth, low productivity. As somebody mentioned before, aging, which is one of the factors that also affect growth, and inflation. So that problem is going to exist. However, when we look in terms of replacement rates adjust for inflation in a comparative sense, because it's how much pension you're going to get relative to final salary. But that's beyond the point. The thing is, let's not compare with what DC did in the past. It's interesting to see it when we talk about the current situation. The current situation is not going to produce high pensions with low with a certain level of contributions as in the past, not only in DC pension plans, in any retirement instrument, the government or anything, except the government can go into big debt if they want, but that's not the case. Just wanted to make the point. Thank you.
No, very well made, Pablo. And I think that's a good way to end our sort of initial segment on the sort of current macro environment in general. What we're going to do now is sort of take a dive into some of these themes a little bit more specifically, and the implications for pension savers at different stages of the journey. And maybe I could come to Philip to think about something that has been a live issue, certainly in the UK, as a consequence of widespread use of so-called life cycling strategies, which tend to automatically de-risk, according to what one might call sort of conventional wisdom, in terms of moving from equities to fixed income as you approach retirement. And just sort of thinking through the implications of rising rates and falling bond prices, Philip, for that strategy. Do we still feel, you know, in the context, and we'll come on to sort of annuities later, that because of the effectively some of the duration matching that will occur with, you know, better value annuities, that life cycling is still going to do its job, or do we need to think a little bit differently?
Well, I think I'd say thank you for the introduction, Jonathan. I think life cycling will continue to do a good job, and of course, again, it's something which guides most investors through. You cannot expect investors individually to work this out, and it's important that there is a helping hand, if you like, to do this. I think, you know, my feeling about this is that obviously it's right in the early stages of accumulation to have equity-oriented, growth-oriented portfolios. That's what builds up that amount of capital, you know, which Stephanie alluded to earlier on. I think clearly as you get towards retirement, you know, I think maybe the UK is particularly anti-annuity, if I can put it like that. So there's very, very few people who'd be looking to use an annuity. I remember annuity converter funds, for example. You know, that's not the way we tend to go in the UK, although I can see, because we'll get onto this later on, I can see annuities coming back. But I think given the length of time many people are likely to live in retirement, entering retirement with some degree of equity does make sense. But you have to get the balance right, because you say you get towards retirement, you clearly don't want a very volatile portfolio. And I take the points Justin made about a group of people feeling they're losers somehow from the system, because that ultimately, if a significant portion of people feel they've lost out, that will undermine public acceptance of the DC system. And that's a social thing I think we have to understand. I think one of the ways the industry can help is to work harder on finding equity with downside protection characteristics. So, you know, not only does equity decline a bit as you come towards retirement, but you also have a bit more defensive equity, ability to equities which are less volatile. You know, certain sectors are less volatile than others, and maybe equities which have somewhat higher yields, although growing dividends. All of those, I think, produce a more defensive equity portfolio. And we've seen actually in 2022 how that can work quite well for some equity portfolios. I'd just like to, so that's kind of technical comment on the asset management side. I just wanted briefly to just make a couple of thoughts about a sort of wider perspective, if you like. So I think you're looking at the UK, which is the only country I really know in any great detail. The vast majority of people entering retirement will enter with a £10,000, as it roughly now is, UK state pension, which is inflation linked. So you've got an inflation linked underpin. I think that's highly likely to remain in public policy for some years to come. And many people in the UK, particularly those with a public sector background, have a defined benefit pension scheme. Clearly, private sector defined benefit is now virtually all those schemes are now closed. So over time, that will disappear. I think probably with that, you will need to amend the life cycling a little bit as we go along to introduce more of inflation protection element to ensure you where DC is going, DB is going down, you have more of a DC inflation protection element. And I think the other point that I just wanted to pick up on, I think somebody referred to this, I can't remember, maybe it was Pablo, that more personalization. You know, it's all very collective. The life cycle default is great, but actually when you get into retirement, people are quite different, they have different needs. And I think we probably will see some more tailoring to individual retiree financial situations in due course. I had some more notes to say more, but I'll stop there and let other people talk.
Thanks, Philip. No, it's really interesting, and particularly, you know, there's a whole other sort of theme there around how we can adapt technology more effectively to customize, personalize, engage people differently with their retirement savings, and bring in a whole range of themes that matter to European savers. But maybe we can, if we have time, we'll come back to some of that. But I'm just keen to stay on this sort of subject of protection and security, and just think a little bit about another sort of potential consequence of a rising interest rate environment, which could lead to a greater attractiveness again of capital guarantees. And again, without sort of, I don't want this to be a UK-centric conversation, but it's been very interesting the extent to which annuities, which have never been popular in the UK, have particularly fallen out of favour in an environment where the rates look extraordinarily unattractive. Both to where the rates would have been historically, but also other asset class returns. And I just wonder, Justin, looking out across Europe, where I know that there is historically a greater focus on capital guarantees, whether you see this sort of turning point in the cycle leading to a kind of reassessment, as it were, of the attractiveness and indeed the cost of providing those.
Thanks. I mean, I think increased interest rates will help. I mean, clearly these reduce the cost of future liabilities. So as Philip said, and as you said, Jonathan, I mean, this will help with annuities. I mean, some of the kind of sums required to buy a decent annuity were grotesque in the era of incredibly low interest rates. I mean, no wonder they were unattractive. They also help, of course, with the balance sheet of defined benefit schemes. But I don't know about a kind of turning point or reassessment. I mean, I think the trend in Europe as a whole in pensions towards DC is very strong. I mean, looking at EIOPA figures, there was something like a 4% shift from DB to DC over a 3-year period, which, I mean, given how slowly things tend to move in pensions, this is quick. Whole countries, I mean, the Netherlands, I know, can obviously speak more about it than I can, but yeah, are moving to a sort of DC system. In other words, the sort of world of guarantees in pensions, increased interest rates will help, but I don't think they're going to make that much difference. I think other factors are equally strong, things like increased life expectancy. So I would expect more of a kind of marginal than a profound difference.
Great, thanks, Justin. And that's a great moment to bring Onno back in. I think technology has provided a way through. I know, and you're back with us. And just sort of thinking about the kind of flip side of rising interest rates, of course, the catalyst for this is rising inflation. And the extent from an investment management perspective that we can mitigate that impact on pension portfolios, particularly in this more challenging macroeconomic context that Pablo described so well. And I think that yeah, no, he's back. No, I think let us perhaps move.
Sorry
on.
about that. Do you hear me?
Yes, I think so. Ono. It's going in and out. Try again.
Sorry, let's give it a try. So maybe reflecting on indeed what was said by the previous speakers. If you look in the Netherlands, there is a move towards more. In the Netherlands, there is a move.
Okay, I think I spoke too soon about it.
Major, yeah.
We're having trouble hearing you. I'm sorry. I think I was probably a bit optimistic when I said it was all fixed.
Okay. You hear me now? I'll stop my video.
Yeah, that's good. Yeah, maybe if you stay off video. Thanks, Ono. Sorry about that.
Yes. So we are. Do you hear me now, Jonathan?
Yeah, thank you.
So we are moving this system, trying to maintain the positives of the collective system. And indeed, I recognize the wish of many to become more, let's say, have a bigger say in how their retirement would look like. So having a little bit of choice here and there would help, let's say, maintain a system that is in its foundation still mandatory, with very little choice options in the Netherlands. If you look at the Netherlands, like in the UK, there is this index-linked bond underlying retirement in the first pillar. So it's an index-linked first pillar pension of about €1,000 a month for a single retiree. So on top of that, you can take more risk. That's what the assumption is, at least for most pension funds in the Netherlands. And one additional observation I would like to share with you is that we treat government bonds as if they are risk-free. And at the same time, we look at the government whenever we need to solve major crises, like COVID, like what I'm doing on climate. Governments will have to step in, at least, well, you can, and assume that government bonds will remain risk-free. It's an issue I'd like to throw into the mix. So how risk-free is a government bond, basically?
Well, I'd like to bring Philip in on this, because he's already referred to the linker market in the UK, which has been very interesting in recent months. I know we're going to have a segment on LDI, time permitting, towards the end. But I suppose one observation picking up from Ono is that actually, due to the nature of who invests in some of these markets and capacity, that we often discover that some of these instruments don't perhaps behave in the way that we might expect from a sort of DC investment perspective. And Philip, I'd love to get your views on that and sort of wider reflections on this point.
Yeah, no, I think that's a fair comment, Jonathan. And it obviously is the case that many people who look at these things closely were perfectly well aware of the underlying characteristics of inflation-linked bonds. But I think it's almost certain that the person, the underlying investor, wouldn't have been aware of that at all, and that probably would have come as a shock. So I can see why that's something that needs to be thought about in context again when you're, particularly when the individual can see the change in their in the value of their portfolio over shorter periods of time. I mean, I've got a couple of pieces of data I wanted to just throw into this. We did a bit of proprietary research recently into the attitudes of UK DC investors, and we surveyed better off people around retirement, just before retirement, into retirement, in the Gen X and baby boomer, obviously, age ranges. And we found that 40% of those surveyed were concerned about inflation. That was in July. I think if you redid it, it'll probably be, or I don't know, 70, 80%. But it's interesting that quite a lot of those felt greatly impacted, and that even extended to more than half of people who would classify as high net wealth. So it's not just those who are in economically more challenged situations. I think everybody right through the wealth spectrum feels that as well. So I think it's quite important. And then secondly, just a bit of demographics here. The Office for National Statistics says that 1 in 4 65-year-old UK men, and this is of key interest to me because I am a 65-year-old man living in the UK. 1 in 4 of us will live to the age of 92, and that could, for people who retire early, mean a retirement lasting more than a quarter of a century. And of course, over that period of time, you know, inflation could be pretty high. And I think somebody else made reference to this. Inflation could settle at higher rates than we've been accustomed to over the last 30 years. And therefore, we will need to take inflation more seriously for post-retirement investing.
Yeah, no, really interesting. And on that sort of inflation theme, and just sort of thinking about the broader macroeconomic environment, I know that we're not, probably quite happy not to be in charge of the economy at the moment. But James, just sort of thinking about the environment from your perspective, and if you're in the position of being able to say to policymakers, look, this is my recommendation for how we can avoid a repetition of some of our historical experience with high inflation. I know that there are great differences between the 70s and the current period, but nonetheless, there are also some sort of strong similarities. And I just wonder what the sort of investment management sort of policy toolkit would be for trying to get us to a better place.
Yeah, and to answer the question, the crystal ball time, I guess, of this session. Yeah, we think that inflation will remain higher in the same way that Philip's just commented, but it will be higher, which isn't necessarily a bad thing, because I think part of the problems we're facing now is that it was unnecessarily low for an extended period of time. So we think it will remain higher. We don't think it will return to the kind of zero or negative levels that we've seen. In terms of, does this turn into stagflation? That is a distinct possibility. If when we're asked to compare this to the past, actually, we don't see it as being like the 70s. If anything, it's more akin to the early 80s, when Volcker was actually trying to get a handle on inflation. And kind of to that end, we think that policymakers were late in reacting to inflation. They were unfortunate in the extent that Ukraine significantly exacerbated it. We think that the Fed as a policymaker is being much more aggressive in trying to get a handle on it. And, our view is that they're willing to risk a recession that they hope will be a mild recession to avoid a prolonged period of stagflation. And they are trying to dampen inflation to the extent that it doesn't become behavioral in nature. And I think trying to do that aggressively and early is a painful but probably sensible course of action. The interesting thing is whether or not, for us in Europe and the UK, whether the ECB and the Bank of England follow suit, which they have done to a degree, but in our opinion, not nearly as aggressively as yet. Although maybe in the coming days, we'll see perhaps a change in sentiment on that front. So that's our kind of view.
Yeah, really interesting, particularly interesting to see what happens next. Onno, is that a diagnosis you would agree with?
I think so. In general, our feeling is that inflation will come back to normal levels, and we believe the ECB will fulfill its single mandate. The weird thing with inflation is that it can be self-fulfilling in a way, right? If it starts to be ingrained in the minds of investors and consumers that inflation will stay high, it will actually stay high. So you will have to act heavily in that. Of course, in Europe, we have the difficulty of countries with high debt levels that we don't want to push over the brink, right? So the ECB cannot go as far as the Fed might think it can go. I don't know how to formulate that properly. So that means that you have to be worried about countries like Italy and making sure they stay on board. So that limits what the ECB can do. But in general, actually it was confirmed yesterday when there was a report was published by the Ministry of Social Affairs, by a committee thinking about long-term equity and other asset class returns, and they said they were expecting that within a couple of years we would go back to 2% and will stay that way. So that's something that is ingrained, I think, in most minds of strategists in the Netherlands. That's the outlook. Yeah.
Great, thanks, Onno. I'd like sort of finally just to draw the session to a close with a question that I think is much more obviously about DB, although I'd be interested, Justin, if you see that there are any sort of read across to DC, but really interested in your observations about what has been a sort of tremendous shock. I don't think it's an exaggeration to describe it as that in the context of the UK DB system, namely the LDI episode of late September, early October, and EIOPA's reflections on the crisis, whether it's too soon to draw any lessons, and just more broadly, how we can ensure that we don't undermine confidence in the pension system.
Yeah, no, thanks. Good question. I mean, in EIOPA, of course, we were very interested in what was happening in the UK. I mean, it was clearly a UK-centric shock, but its potential implications were kind of were felt around the world, including in the EU. In terms of what EIOPA has looked at, I mean, two things. One is the extent of exposure of EU pension funds to UK gilts and the kind of affected instruments. And actually, the answer there is very little. I mean, there's not much exposure, but of EU pension funds. But the second and the kind of more important reflection is whether the same thing could happen in the EU. Are there similar investment strategies implemented by EU pension funds? As you say, I mean, it is preliminary, but we certainly cannot rule that out. That there are pension funds in the EU that use these LDI strategies. Now, our best guess is that something like this would be of lower magnitude because of the depth of the European sovereign debt market, that the acute pressure that there was on gilts would be less likely to arise in the EU context. But again, Onno, who runs a huge pension fund, will should have something to say there. Your final question, one of the question was on what are the implications for DC? I think here it's important to reflect that DC means lots of different things, and actually pure DC, i.e. the absence of any guarantee, is kind of a relative minority, and that if you have some form of guarantee, then you start to have these sorts of risks can start to apply. So yes, I mean, yeah, there are consequences for DC because DC is often not pure DC. In terms of what EIOPA is doing, as it happens, we are already preparing advice on the review of the IOP2 directive for occupational pensions in the EU, and we've been asked to look at this as part of that. So we will do so. There are potential issues around requiring specific risk management measures on liquidity. That would be one potential response. Thank you.
Thank you very much, Justin. And as we move towards 4:30, I think it's only right just to hand over to Pablo for a couple of minutes to have the last word and round off what I think has been an extremely rich and diverse discussion. Pablo. Oh, sorry, can you unmute?
Sorry, you're right. No, if I may, I would like to say something about what happened in the UK. My personal assessment, and I'm not here, we are still, as Justin said, looking at what it means. We see the problem, we don't see the problem in the LDI per se, but on the investment practices of derivative, leverage, and lack of liquidity. In that sense, can it happen somewhere else? Well, as long as pension funds, DC pension funds want to search for yield, even though they don't have guarantees. But as Justin said, most pension funds do have some degrees of guarantees, even soft promises that they want to achieve a certain replacement rate and things like that. If those practices of derivatives with margin calls and hedging, leverage and liquidity are a common practice, although the data we had 3 years ago didn't suggest that that was the case in many countries. But if those practices are there, yes, we can see a problem going forward, because as I say at the beginning, we are now in a wall of uncertainty, and things can overshoot or downshoot very easily, and how those derivatives and hedgings are done are very important. And one, this is just a question for some of you in the future to talk among us. I would like to know how those pension funds doing LDI in the UK had those derivatives. Were they hedging interest rates? Were they selling their government bonds to financial institutions with an option to buy them, and the margin calls were on the price? I really don't know how all of that was. And here calls for much more supervision of what these practices are going on from my point of view.
Thanks, Pablo. And I think no doubt there will be much more discussion. I think a lot of this goes fundamentally back to funding and how pension schemes, particularly those that are making firm commitments, are able to effectively match their liabilities and assets. But fortunately, I'm probably saved by the bell from saying too much more, because we are almost at 4:30. And in the interest, I'm sure, of everyone, particularly in continental Europe, who's actually at 5:30, I should say a very big thanks first to Stephanie and to Pablo for presenting what is a fascinating set of provisional findings, and we'll look forward to seeing the full report in due course. And also many thanks, of course, to our panelists, Philip, Justin, Honor, James. Really appreciate you taking the time to be with us this afternoon and to share your insights. I think there were so many things that I feel we barely got started. So maybe this will be the first of many discussions. And thank you to EFAMA for providing the platform as part of European Retirement Week. I hope everybody has found this useful as webinar viewers, and look forward to connecting with you in due course. Have a very good rest of the day, and thank you again.
Well, thank you, Jonathan, for a very nicely well conducted panel. Thank you.
All the best.
All the best.